Bring in Margaret Patel from Wells Capital Management. We will talk bonds, and surprisingly, over our years of conversations, equities is well. With the Wells Fargo Advantage funds, are you doing a pure bond portfolio? Do you doing a blended portfolio? Or are you now all equities because bonds are dead?
I do two blended funds, one mostly fixed income, a little equities, the other mostly equities, a little bonds. So I have the advantage of both.
The blended fund for the Arch retiree, it's a standard 60-40 split, efficient market theory. Explain this. Efficient market theory is what's the most efficient, what's the best portfolio given the volatility or the gyration taken. 60-40 split, is that so 1980s?
It really is 1980s. I think you have to be much more dynamic in switching between the two asset classes because the relative values have changed that much.
What's a determinant to know when equities are cheap? Is it price to equity? Is it price to sales? Just as a general rule of thumb, how do you say, hey, equities are cheap?
Well, I look at all those things, but in market cycles, the variance change depending on what people are looking at. I like to look at rising revenue, rising profitability. In other words, an industry that's on the upswing.
And you mentioned to me earlier this morning on Bloomberg Surveillance, financials isn't in that group.
No, because I don't think they have the growth potential. They've done that. That's why they're digging out of the hole. I think other companies that really will enjoy the cyclical upswing here in developing markets.
Well, this is a dreaded first chart, Margie. Let's bring it up here. You can see it down here on the monitor. A return to high-yield normalcy. This is the BAA industrial compared to the full faith and credit 10-year. There's that crisis. We're really, is it safe to say all things are normal in the corporate bond market?
I think all things are normal. I think it's going to be a very good market, very tranquil, low volatility.
Okay, what did the gloomsters get wrong about defaults? There was this whole idea of defaults are going to be terrible, world's going to end. That really didn't happen, did it?
No, it didn't. I think what you need for default is you need a lot of really poor quality companies that were able to access the market. And you really didn't have that many excesses going back to 07 and 08 to be defaulting now.
Okay, here's another chart. We're going to squeeze some in here, folks, as we've got two nice blocks here with Margaret Patel. High yield, nominal spirit. It's just nominal GDP, top line GDP with a little bit of inflation folded in to real GDP. And you can see we've really come back from the crisis. I think, Margie, that's a story a lot of Americans really aren't aware of, that we've come back nicely, haven't we?
Yes, yes. We are just about where we were a couple of years ago before we had the solvency crisis.
And when you look at the animal spirit that's out there in the corporate world, do you suggest it will continue in 2011, that we'll continue to see the revenue and the earnings growth that you think is so important?
I think the economy has done a remarkable self-healing job. I think that corporations in the U.S. have restructured over the last decade or so. They were prepared for nuclear winter when it came. They were ready to operate and still have positive cash flow. So corporate America's in great shape. Corporate America's in great shape,
and I get so many notes from viewers that say, well, that's great, I don't feel that good. Do you care that housing's moldy, like how weather-affected housing starts this morning? Do you care about a bad housing industry?
Well, housing is a small part of the economy. It's only about 3% of the economy, about the same as autos, which is actually on the upswing. And it's true we probably have another 5 or 10% down in prices, but think of where we've been. We've already had 25-30% downside. So housing is almost done with the correction process.
In your equity watch, do you like housing equities here?
I haven't cared for housing equities, period, so I wouldn't be interested now.
I want to look at this. This is completely, I'm going to surprise you with this, Margie. Too much information. Bring it up here. We're going to do it early in the show today. This is currencies. Don't bet the one-way bet. Here's euro dollar, and everybody's screaming weak euro. It's been an ugly 2 weeks for those screaming weak euro. We're at 135. Where are we? I can look over here in the Bloomberg. My eyes are failing me, Margie. Help me here. Euro dollar, $1.3494. Ouch for those screaming weak euro. You've been doing this for years. When you look at bonds, and there's always that one-way bet of gloom. What's the one-way bet right now that scares you? Is it everybody on board the commodity trade?
I think a little. There's a lot of fluff and enthusiasm, emotionalism in the commodity trade. A lot of that is tied to presuming the dollar will continue to weaken steadily. I think we're more in a trading range there, too. But I think commodities are going to do well.
Yeah, well, you look at China. I mean, with the president's greeting of the president of China, there's just an assumption here, China forever. That would be another one-way bet, just China, China, China. How do you play that?
I think China is on a long-term high-growth path. They've done a pretty good job of managing their economy, and I don't look for China to blow up, to suddenly disintegrate. I think they're going to continue to be a source of strength throughout the world in their global growth.
Okay, I want to play this bite from this morning. Earlier this morning, I spoke on Bloomberg Surveillance with Fred Goodwin of Nomura International, and I asked him to explain his idea that the U.S. were getting a free lunch.
You know, they've done quantitative easing. They've extended the tax cuts. They're promising a 2% payroll cut, and the Fed is buying bonds to pay for it. The U.S. is getting a much better macro outcome. Milton Friedman was wrong. There is apparently a free lunch.
Fred Goodwin, I love that. Nomura International. Margaret Patel, free lunch. I mean, it's classic. What's on the other side of all this economic free lunch we're getting?
Well, unless we lower the deficit and lower taxes, I think it means lower growth for the U.S. So I don't think there is a free lunch. I think we'll have to pay for it down the road.
Do you see any indication of the political dialogue beginning to get there?
Yes, everyone is talking about it. We got a sneak peek by looking what's going on in Europe to see what can happen. So I think people are much more sensitive, politicians in particular. Let's
look at this elegant chart. Patel, less opportunity in the banks. I knew that because Margie was on radio with us this morning as well. Here's Keefe Bruyette Bank Index down there in white from the beginning of the crisis, and the cap goods S&P index. You like the cap goods, as do a lot of other people. I want to focus on the banks. What makes you uncomfortable in the banks?
Well, it isn't so much uncomfortable. It's just I don't see where they can get a lot of growth. It looks like they've started to lend again, which would be one small source of growth, but all the other growth paths were structured products. We're lending to subprime. We're lending to new unserved markets, which meant higher credit risk. That all turned out pretty badly. So I don't see that they can really grow as fast as other sectors like tech, like the industrial goods sector, which have the cyclical upswing.
How do you manage the desire to get out in front of the M&A rush? I mean, can you predict a given merger, whether it's in banking or in the industrial space?
I think the best indicator is to look for a company that controls its own destiny, that has unique products, that has something that can't be easily reproduced, and those are the companies that usually get acquired if they're more in the mid-size area.
You know, Larry Haverty in Boston years ago was State Street. Now he's at Gamco. The media, is there value there?
Again, I think it's a pretty much built-out, modest growth market, and again, I'm looking for developing market growth.
Okay, I want to bring up this quote. Doug Cass, thanks for listening, or watching rather, this noon out of Florida. Let's bring up this quote that Doug just sent me. This is the economist, the political economist, M. Twain. We're trying to bring that up right now. Elian, you going to be able to bring that up? Oh, it's down on the screen. I see. I thought we were bringing up the one. That's my fault, folks. I was wrong. History doesn't repeat itself. At best, it sometimes rhymes. Mark Twain, there it is from Doug Cass. I mean, how do you manage money today after this crisis? Is it the same as you've been doing it for years, or is there a new Margaret Patel?
Well, I think I look at 08 as a 100-year flood. It'll never happen again, so I'm not going to act as if tomorrow is going to be 2008 again. And I think that what you have to do is see that leverage is really an enemy for investors. And I think it says the pendulum has swung from bonds being the best investment over to equities.
Well, you look at that over to equities. Okay, so you're focused on that. Are you just suggesting bonds make the coupon and that's it?
I think so, and some people think rates will drift higher. I don't. I think we'll just be in a trading range, so it gets 3 to 5% from.
You don't agree with Byron Wien 5% 10-year yield?
Not for 2011. No, I think it's way, way premature.
Interesting. Why?
Because one, the inflation indicators that guide the Fed, who is going to set, are one, expecting to see low rates. I think they'll see low rates of inflation.
Right.
And two, they would like to see a little more inflation before they tighten. We're a long way from a sustained 2+ rate.
Okay. Pros like Margaret Patel, folks, look at the return, and they also look at the volatility, the emotion it took to get there. William Sharp, Stanford, with the Sharp ratio, coming up with this years ago, winning a Nobel Prize for that work, and others. Here's a chart. Are equities worth the volatility? You're one of the 5 or 6 people really in the pro field that have this just ingrained in your heart and your soul and your work. Here's a chart, Margie. It's the same good capital goods index. It's an industrial index, climbing back nicely. That's where you want to be. But look at all those wiggles along the way. I mean, there is more volatility in equities and bonds. Do I have that right?
Yes, that is right. But volatility isn't a bad thing if you're a long-term investor, and it lets you buy low and sell high, taking advantage of these short-term volatility swings that aren't based on real fundamentals. When you and Dan Fuster get together for a cup of coffee up in Boston, you got to talk about value. He used to buy non-callable discount bonds. It's so charming. It's so back there. Is there, back to the S&P, the blue book, bond book? How can the little guy play in bonds now? Do they just have to buy a mutual fund or an ETF? They absolutely do. Bonds used to be listed in the old days. There used to be a lot more industrial companies than there are. There just isn't the selection. It's all really round lot, $1 million market. $1 million is a round lot. Yeah. That's scary. Let's look at this. Commodities. I want to know what Margaret Patel thinks of commodities. Just note of the day. What a smart note. Michael McKee agreed with me on Andrew Tilton's work at Goldman Sachs. The aftertaste of high food prices, our analysis suggests an average lag of 7 months from commodity price changes to retail food price changes. Is that good or bad for food stocks? Actually, it depends how successfully they can pass it on, and I think that some of them, with a lag, are able to pass on those higher costs and higher margins. So it doesn't hurt them if their margins, once you get past that initial uplift in prices. To get international exposure, do you buy the BHP Pelotons of the world, or can you buy it through American MNCs? Well, I like to stick with U.S. companies because a lot of them have, sometimes even the majority of their revenues coming from overseas. Plus, I think we have better financials. The veracity of financial statements is always important. Amazing. I look again at the work you're doing of moving from bonds to equities. Let's go to the heart of the matter. What's the appropriate return that someone can suggest from, say, an 80-20 split, 80 equities, 20 bonds, whatever that mix is? Are we in a single-digit world? Certainly for bonds, I think we are. Even for high yield, maybe high single digits, but high digits nonetheless, because you don't have the room for capital appreciation. With most bonds trading at premiums over their face value, that's a pretty low ceiling to get more capital appreciation. Plus, you have the risk of what if rates start to go up. Right. Margaret Patel, thank you so much. Margaret Patel with us, Wells Fargo, Advantage Funds, and Wells Capital Management.